Zoom, waking up this city that never sleeps. Um, Before we start with the presentation, I wanted to say some thank yous first to Mayor Mintz and Burton LLP for partnering up with us on this event. I would like to thank the panelists that took their time to join us today: Pamela West of Nuveen, Gary Rodney of Tishman, and Scott Alter of Standard Communities. I would also like to acknowledge Legal Outreach, the organization that we're promoting today. As every time we do coffee and cap rates, Legal Outreach is an after-school program helping inner city students get into better colleges over time. And the executive director, James O'Neill, is here with us today. James graduated Harvard Law School in 1982 and decided to take a public interest fellowship in order to help others gain the insight and degrees that they can and advance themselves in life. And for that, we're eternally grateful. You've done something for others instead of just taking care of your career, which is amazing. We like to encourage each and every one of the participants here, people that view this, that are in real estate, to join us in supporting Legal Outreach, either through the program that James will talk about or through contributions that are welcome. James, would you please come up and give us a few words about Legal Outreach?
Absolutely. So thank you so much, Shimon, for that introduction. I'm always humbled by the support that you and your partners and the employees of Ariel Property Advisors have provided over so many years. I'm also grateful for the enthusiastic support of today's co-sponsor, Mayor Mintz from Burton. Let me just say good morning to everyone. First and foremost, I hope that all of you are well and that your families are surviving through this sort of challenging time. That being said, with new leadership in the White House, I'm sure we're all hoping for a return to a new normal. But let me say that that new normal can't be a reinstatement of the status quo, where a few are blessed with opportunities, but the great majority within our society are left out of the equation. As a nation, we must do more to provide opportunities for the poor, the disenfranchised, and minorities, most especially, who have not had a fair shake in their pursuit of the American dream. Yet it can't just be the federal government that seeks to equalize opportunity and pave the way for a more just society. The private sector must do its part as well, which of course includes the real estate industry. I'm proud to report that since the last Coffee and Cap Rates event, a number of real estate firms and companies have stepped up to the plate to expose high school students of color participating in Legal Outreach's College Bound program to career opportunities within the real estate profession. Those companies include Ariel Property Advisors, Burton, Fisher Brothers, Camber Property Group, and Signature Bank. Each has conducted or will be conducting a 2-hour virtual workshop that is exposing a committed group of 20 high school students within our program to career tracks within their companies. The impact has been tremendous. The chosen few who were previously thinking only about careers in law are now starting to make the switch to your line of work. The only problem is that we're serving 200 additional students who are jealous and are disappointed that they weren't selected to participate. You and your company, however, can help rectify this problem. If you're interested in helping, again, it's only a 2-hour virtual commitment. I invite you to send me your name, the name of your company, and your email address. You can find my contact information in the chat window shortly, and it will be shared in a post-event thank you email. Even now, we're starting to set up the second year of the program that will commence in October and run through May of 2022. If you're not able to set up a virtual presentation, but you would like to become involved, We invite you to make a donation to support the program, or we invite you to introduce us to a foundation that might potentially fund the growth of this program. You'll find the link for donating in the chat window. If you believe in social justice, which I'm sure many and most of you do, if you want to be a healer of the breach within this nation, and if you want to make a difference in the lives of willing and eager youth, then supporting our professional exposure program known as Let's Make a, quote, real estate deal is a great way to do so. It's a simple and pain-free way to become a part of the solution to one of the problems that vexes our nation. I look forward to hearing from each and every one of you and corresponding with you soon.
Thank you, James. Thank you for this. Okay, let's get going. I'm going to speak for the next about 10 minutes about what we've seen in 2020, and I want to bring us all back to February of 2020. Many of us were sitting in Club 101 doing the same thing we're doing now, talking about real estate, sipping coffee, only it was in person. And 30 days after, these were the pictures of Central Park becoming a hospital, pictures of people being infected with COVID, words that we haven't used before, like social distancing, super spreaders, unrest, social unrest, masks, and a very tough election year. And the reason I'm bringing us all back there is because we still have a lot of issues to work through, but from a real estate perspective and from a fundamental real estate perspective, we believe that the worst is behind us. And what we're going to do through this presentation, we're going to talk about the 2020 numbers. We're going to talk about some pockets of strengths that took place in 2020. And we're going to talk about some initial shifting fundamentals that we've seen in the very last quarter of 2020. 2020, in terms of volume of transaction, was a low year, $18 billion only, about 50% lower than 2019. And if you look at the financial crisis times in 2009 specifically, we were only at $6 billion. So today we're about 3 times that number. We also believe that the volume of transactions moving forward will increase, which means that 2020 has been the bottom year for dollar volume of transactions. Pricing in the multifamily arena has been down throughout all boroughs, not just because of COVID-19, but also because of the HSTPA, the Housing Stability and Tenant Protection Act of 2019 that affected rent-stabilized multifamily. Land values were mixed. They were down in Manhattan below 96th Street. They were up in the Bronx and in Queens as a result of some industrial and specialty use purchases that took place. This year is defined by reaction. What we've seen in the first months of the pandemic is a business closure in many cases and a very sharp and quick rise in unemployment over the first 3 months. And at the same time, we've seen a decline over the next 6 months and recovered about half of the unemployment rate by the end of the year. So very sharp and speedy reaction to the pandemic. If you want to look and compare it to the financial example, took us about 18 months from the lowest of 5 all the way down to 10, and about 6-7 years to recover. Here we're talking about really months. And this is a health crisis, not a financial crisis. This is a crisis where we do have liquidity, but what really characterizes it is the lack of uncertainty in the real estate fundamentals. In May, we had this headline talking about 420,000 people leaving the city. We know that many of them came back in September, not all of them, but this is the result of that. Lagging indicator of vacancy rates in Manhattan below 96th Street. The vacancy rate went up from close to 2% all the way up to 5% and continued to increase until very recently, where we started to see declines in the vacancy rate as a result of new lease signage increases year over year. And these were substantial leading indicators, believing that the city is starting slowly but surely to recover. We believe that this trend continues, that the vacancy will continue to come down in 2021. The commercial market, office, retail, hospitality, did not do well this year. Actually, in office, there were some very interesting pockets of strength that we'll talk about. The retail market entered the year in a very weak footing and continued so, mostly because of businesses that faced closure during the pandemic. And the hotel and travel industries clearly suffered the most, and we'll have to find solutions in addition to just going back to normalcy for that. Where's the distress? Everybody's talking to us and asking about distress opportunities. We haven't seen many of them in 2020. We believe we'll see some of them in 2021. The one thing that I wanted to mention here, it's not going to be as severe as it was during the financial during the financial crisis. And the reason is conventional lenders during the past 10 years have been relatively conservative when it came to lending. So the equity buffer is relatively high. And in the multifamily sector specifically, transitional lenders that are in the process of taking some buildings back have already indicated that many of them would want to keep the buildings and add value and sell down the road. So note sales and foreclosures will be there, but not as many as we've seen during the financial crisis. So what are the pockets of strength? Well, the first one is the affordable housing and multifamily capital. And today we have all of our panelists are experts in affordable housing and will be leading us through a discussion about affordable housing in New York City as well as outside. Affordable housing has a few things going for it. First, the certainty of collections, which was so important during this time. Secondly, the ease of financing, mostly with agency loans that are usually also less expensive than conventional. And lastly, the fact that in many cases you can fix this way or another the taxes. So your ability to project yield is extremely high, and during uncertain times, this is a product type that does very well and probably will continue to do so. But we also saw some capital going into free market buildings. For example, KKR investing in a brand new Brooklyn building together with Dillon Management, and we've seen A&E investing in an SL Green building in Midtown Manhattan. Both companies have to believe that the rental market will come back relatively soon. Other pockets of strengths are industrial. We've seen a 45-acre Staten Island land sold for Dov Hertz, and that's going to be a logistics center over time. We've seen a deal between Taub and Mana. It's a business with a building specialty use, and we remember the Silvercap Studios, which Hackman together with Square Mile purchased earlier this year. These are pockets of strength, and the last one in terms of leasing activity in industrial is Amazon. Who said Amazon is not coming to New York City? It's in New York City in a big way, taking approximately 1 million square feet of logistics centers between Brooklyn and Staten Island, but also taking a big building as a tenant for 10 10th Avenue, which sold earlier this year, and purchased a building, the Lord & Taylor building on 5th Avenue earlier this year for close to $1 billion. The leasing activity in the tech industry has been excellent. We're talking about Netflix, TikTok, Facebook, and Apple that took spaces during the pandemic. So these are some pockets of strengths that we thought would be interesting for all of us to review. And then the lending environment for good sponsors, good locations, and great assets. We've had ample lending, and these are just some examples of that. So just to summarize, we see some positive fundamentals shifting in the right direction. New York State new business application went up drastically during the very end of 2020. Some of it is probably leading to less unemployment, which we hope will continue through 2021. And the residential rental market at the very end of 2020 showed very good signs of resiliency, as if the market has found its footing. So what should we expect in terms of headwinds and tailwinds for 2021? The first thing that comes to mind is the local politics, both on the state level and city level. We have city elections this year, and everybody's anticipating to see what the outcome of that is. Clearly, crime is an issue that it's on a lot of business people's minds, and we have to see how our leaders and politicians handle crime in the city. And the last part is the mutations of COVID-19, which are definitely headwinds, and something that we should watch for and take a look at. But in terms of the tailwinds, the first thing is a vaccine. We have one, and we hope that by the end of the summer, many of us will be already vaccinated. The confidence might return to the city, and we hope that in September, we'll see more colleges and universities open, which can bring students back in and change the face of the city even in the last quarter of 2021. The interest rates are low and accommodating when it comes to the real estate asset class. In every real estate crisis in New York City, we see national, international, sovereign wealth, family offices, and high net worth coming into the city and looking for opportunities. We're seeing it now, and many of them end up placing bets. And I think that this is the year to start seeing that, and next year as well. Repurposing of hotel, retail, and office with the help of the city is crucial and is an opportunity. The fact that the land market is low will show us probably some more rental buildings will come up. The fact that the affordable New York or 421A sunsets at the end of 2022 will probably push some developers to either develop or sell, some more movement in the land market later this year. Pricing clarity, especially in the multifamily asset class, post HSTPA is important, and we're seeing that happening. Continued strength in both affordable housing and industrial market is something that we anticipate moving forward, and new businesses as a lower barriers of entry for retail and office has been presented as an opportunity here. So this is these are the tailwinds of 2021. As you can see, many more positive influences that we see here than anything else. And that summarizes my presentation. And I'm going to stop here and hand it over to Mayor Mintz to start the discussion with the panelists. Thank you.
Thank you, Shimon. I'd like to welcome our esteemed panelists. Thank you to Ariel Properties and Legal Outreach. Before we get started, I just wanted to remind everyone there is a Q&A button on the bottom. We'll try and weave in as many of the questions as we can. To the extent we do not get to them, they will be addressed in the follow-up communications that are going to be sent out to everybody. With that, welcome panelists, and thank you guys for taking the time this morning. Before we get started, I just wanted to give you guys an opportunity to introduce yourselves. Tell us a little bit about what you do, what part of the real estate sector you're in. Pamela, you want to start it off?
Sure. Thanks, Mayor. And good morning, everyone. Thanks to Ariel for inviting me to be a part of this discussion. I am Pamela West with Nuveen. Nuveen is the asset manager for TIAA, which is our parent company. I sit on our impact investing team and adjacent to our $130 billion real estate platform, where we focus on all of the major real estate sectors. But I lead our affordable housing preservation strategy, which is strongly supported by TIAA's balance sheet. We have been investing in the space for several decades with different fund managers, and most recently started scaling our own direct portfolio. Our direct portfolio has grown to just under $1.5 billion in what we call deeply affordable assets. So those assets that really serve tenants below 60% AMI across the country. And we work with various operating partners, great operating partners across the country that are very much aligned with our strategy and care about impacting residents and communities. So, because I sit on impact, every investment we make has an ESG angle and also a financial return. We don't see those as mutually exclusive. because we do believe that impact drives value for our residents. And so, look, hey, I'm really excited to have this discussion with Scott and Gary.
Thank you. Scott?
Sure. Well, thank you so much to Ariel Property Advisors, Shimon, and to Mayor. And I'm honored to be on the panel with Pamela and Gary. So thank you for that. So yes, I'm Scott Alter. Born and raised here in New York City. I'm a father of 3 daughters and live on the Upper East Side here. So I'm the co-founder and principal of Standard Companies, which is a parent company of Standard Communities. We were founded over 12 years ago, right in the financial crisis, September 2008. Standard Communities is an affordable housing developer focused on creating and preserving affordable housing around the country. We own and operate over 13,000 multifamily units across 16 states, from Hawaii all the way to Massachusetts. 2020 was actually, despite the turmoil that we all went through and we're still going through and continue to fight through with the pandemic, was a banner year for Standard. We acquired over $450 million of property and really was fueled by some of the things that Shimon said, in that, you know, affordable housing is desperately needed. We have a housing crisis across the country. Certainly here in New York City, it is a major crisis. And so we saw, whereas our friends in the market rate space, and we do operate in the market rate space as well, but our friends in the market rate space had trouble with collections, and obviously watched it very closely and saw collections dip by, you know, somewhere from 5 to 10%. Which, you know, everyone's saying is not that much, but on any pro forma would be a lot of value and a lot of cash flow loss. But you know, in New York City, we saw even worse than that. But in affordable housing, we really didn't see any drop off of delinquency. So that is a lot to do with the stability of affordable housing. And I look forward to talking on the panel with Gary and Pamela some more.
Thanks.
Thank you.
Gary?
Thank you. And my name is Gary Rodney. I am the Managing Director of Affordable Housing at Tishman Speyer. Tishman Speyer, as many of you may probably know, is a global company. We're an owner, operator, and developer of real estate in many different fields. And I was brought in last fall to actually start this affordable housing platform. So I was brought in to kind of create and preserve affordable housing, starting here in New York City, but actually to grow it into a national platform. And I come to Tishman Speyer with about kind of 20 plus years of experience, specifically in the affordable housing space, both in the public and private sector. When Mayor de Blasio was first elected, I was part of the housing team to help kind of actually craft the Housing New York plan to create and preserve 200,000 units, which has grown to 300,000. In addition to that, I've been an affordable housing developer, and I was also the chairman of a national tax credit syndicator. So I'm looking forward to the discussion with Pamela and Scott, and I'll pass it back to you, Mayor.
Thank you,
Shimon,
Gary.
you're a man that needs no introduction, but I guess I'll give you an opportunity.
Oh, sure. Shimon Shkury, President, Ariel Property Advisors. You know, we're a commercial brokerage firm with 3 divisions: investment sales, investment research, and capital services. But I just wanted to say something to everybody who's watching. If you have any questions, please send them into the Q&A. We'll pick them up and try to answer them as soon as we can. Thank you, Mayor.
Thank you. Just as a quick introduction, I'm Mayor Mintz, tax partner at Burden LLP, a top 30 accounting and advisory firm. We actually do all aspects of real estate, but lately we've seen a big uptick in our housing practice, just because that's where a lot of people were going. We do commercial real estate in Manhattan and all over the country, residential real estate, capital A affordable, lower A affordable, and basically anything in between. We're a lot of transactional work, so we're obviously comfortable in any of these situations. So I guess, you know, diving right in, we've seen a lot of stuff go on with COVID, with the rent rules that impacted the market in general. I know you guys were talking about on the affordable side. what do you think really impacted that area the most? We'll start with Pamela again.
You know, I'm going to get on my soapbox about the lack of technology in the affordable space. I think, like Scott said, the transaction activity really, you know, we were grateful, I think, over the past year. Scott says he had, you know, they had one of their best years, and so did we in the affordable space. So, you know, that was really, you know, if there's a silver lining or a positive aspect of it is, you know, we were able to preserve way more housing last year than we have in the past. But the technology aspect of it from a COVID perspective has really been disheartening. You know, as people are stuck at home and you know, kids are distance learning, and they, you know, you need Wi-Fi to do so many things. Our community centers were closed. You know, seniors experience isolation. And so, you know, if I had to say there was one thing, Mayor, that really bothers me, it's that. You know, and I'll just put in my, you know, my stake here and say the government should provide, you know, everyone who lives in affordable housing free Wi-Fi.
Scott?
Sure. Yeah. So, I mean, I think that, you know, New York City residential real estate was, you know, substantially affected from a value perspective, but also from a, you know, sort of cash flow perspective because of the rent regulations that, you know, were enacted in New York State. So, you know, it really, and, you know, and that sort of began a lot of the problems on top of, you know, property tax rises that we've just continually, increases that we've just seen continually at, you know, well over inflation numbers. So that was pre-pandemic, and that was already, you know, hitting some of the, and then this is sort of more in the lowercase a affordable, as you put it, Mayor, you know, markets. And then, you know, and then obviously with the pandemic and just a flight out of New York City because of it, that there was just big impact. I would agree with Shimon's presentation that we've seen in our portfolio that just the slightest uptick of, you know, leasing activity in residential, you know, leasing that's been a positive. And on the affordable side, you know, the pandemic has highlighted what should have been even more highlighted than it is, and that we are in affordable housing crisis. And it's true across the country. It's true even more so in New York City. And so, you know, by having the government as, and I would say some of the stimulus acts were actually very positive for, you know, for the affordable housing business. The flat 4% tax credit rate was a big boost that we hope will see substantial increases in affordable housing units across the country, here in New York City as well. And so there were some positives that came out of the stimulus bill for the affordable house, capital A affordable housing industry. But the problem's still there. So.
Do you see that vacancies are going down because of pricing changes, or it's just the actual people coming back?
I mean, you know, it's very anecdotal, but you know, because it's just ever so slight. You know, we would say that you're seeing some leasing activity. I wouldn't say that. I mean, I think the rents have bottomed out. You know, concessions have bottomed out, and you're just seeing a slight uptick in people coming back, or at least planning to come back. So but it's very early, and I personally am a believer that people can't wait to be done with the pandemic and are going to you know, flock back to the cities. And it may not be right away, but I do believe in New York City for the long term. I'm here, and you know, it might take a little bit of time, but I do believe that it will be sooner than later.
Gary, what do you see?
And it'll come up
Oh,
quickly. No, that's okay.
What do you see as the biggest threat and biggest obstacle that you've had to overcome in the last year or two?
There's so many, to be perfectly honest with you, but I think, you know, Scott hit the nail on the head where he said that we are in an affordable housing crisis. I mean, now it's even more pronounced here in New York City, but across the country, you see, no matter where you go, people are struggling to pay their rent. I think over 50% of tenants across the country are rent burdened, which means they're paying more than 30% of their income towards their rent. So, and even if you go to smaller markets in the Midwest or in the Southwest, the overall numbers may be lower than they are here in New York City or the Bay Area, or take your pick, any large city across the country. But when you see that percentage increase, or the percentage that people are paying towards rent, it's significant. So I think those are some of the huge challenges that we've been seeing. A bright spot, which Scott touched on, I just want to expand on slightly, is he talks about some things that came out of the stimulus bill. You know, I've been in the affordable housing industry for over 22 years, and I think this was the first presidential election where not only there were multiple people who came out with a position on affordable housing or having a strategy to actually tackle it. So there were a lot of challenges, but to me, some of the bright spots are the need that has been more pronounced. There's proceeds and resources being put to fund affordable housing or to help create and preserve it. And there's people like the folks on the screen, and I'm sure many people who are listening and who are trying to do their part to actually help create and preserve more of it.
I know you spend time in the public sector in addition to the private sector, and you're also doing stuff across the country. Is there anything that other cities or states are doing that are different or better than New York that you think we should start thinking about?
I always think New York is one of the best, right? But just because this is home for me. But look, there's a lot of creative things that are happening in different places. I think one of the benefits that we have here in New York is the amount of resources that both the city and state are putting to help create and preserve affordable housing. In addition to all of the federal resources you're seeing, there's true dollars that are being put in to help make this happen. So other states are following suit. I think some states are looking at some creative structures, not only in just in terms of the capital dollars that are being spent. They were looking to create a lot of state tax credits and things of that nature to help make more of this happen. Now, as a result of the pandemic, the tax need is going to be a little bit different. So that we'll have to wait to see how it actually shapes up. But I agree with Scott in the fact that I think a lot of cities are going to come back. I mean, Shimon touched on this a little bit when you see what's happening with the vaccine. As that starts to get implemented across, I think ultimately you're going to see people come back to the cities, and hopefully, you know, the economy will continue to improve as a result.
Shimon, I know you're involved in sales too, but is there anything that you see investors look at that they didn't look at a year or two ago? I know obviously there's a lot of things that have changed, but are people now approaching you that you didn't think would have approached you in the past?
That's a great question, and it falls right into the affordable housing question. I think one of the things that our team is seeing regularly is new capital that is interested in investing in affordable housing. I mean, Tishman Spire is one example of a platform that wants to develop that in a bigger way. And I think that especially during these kind of times when there's a flight to yield and a flight to certainty and understanding of how taxes can be fixed at, during certain times, and understanding how the financing works is really interesting for certain capital. So that's really what we're seeing. We're seeing newcomers to this space. We're seeing a flight to yield, and that helps. And the more impact investing you see helps that as well, because if you're raising a fund or if you're going into a deal and you can get these kind of sources of capital or more of these sources of capital, that creates more liquidity for that market. Gary, I'm sure, remembers that 15 or 18 years ago when another platform started, there were about 2 or 3 or 4 players that did only acquisition rehab. And all the conventional players would not be really there. And so it was less of a competitive and liquid market. And I think that the more the liquid that market is, the more knowledge you have about affordable and the more capital you have for it, I think we're all better off. So that's kind of what we're seeing throughout this pandemic.
Thanks. Scott, I know you mentioned before about rising costs and trying to control them in a lot of the residential buildings, especially the ones that are price regulated on the rent side. Have you seen anything that people are doing now that they weren't really thinking about in the past?
In terms of expense savings?
Yeah, just looking, I mean, in the past, it was easier to raise the rents, and especially in the free market rent area, people were kind of just raising rents as the real estate taxes go up. But as the rents start, not being able to be raised as frequently or as much, is that something you see people doing anything differently about?
Honestly, it really is just, you're going to do what you can on the cost side. And, we'll sort of, property taxes, like I mentioned, is the real driver of that. And there's really not a whole lot of control that you have now, as Shimon mentioned, on the, on the capital A affordable side, where you have deed restrictions. That is a situation where, New York City and New York State, they are leaders, as Gary said, in terms of controlling property taxes to promote affordable housing, to help, sort of stimulate the affordable housing, inventory. And, we see that across the country in different jurisdictions, that every jurisdiction really handles property taxes differently. But I do believe that's a key driver of how we can, increase our affordable housing stock across the country and in New York City.
And Pamela, I know you talked about impact investing and ESG investing. Why don't you give us just a little introduction of what are the kinds of stuff that you look for in a project when you're talking about the return, but also the ESG factors?
Yeah, I mean, we focus on, all things really ESG. When we, acquire property, we do a climate risk study as part of our due diligence. We think about how tenants are affected in certain areas, whether it be wildfires in California, or we even dug into one property in Florida and determined that there are 3 really hot days in Florida that we needed to address for seniors in that community. So we think about climate. I think green retrofitting is pretty standard across our industry, which I'm really grateful for that people are focused on that. Especially in the preservation space. And then, social impact is really huge. We think about how do we set up programming for our tenants, programming that really matters to them, that can make a difference. And I often talk about, just after school tutorial programs mean a lot for residents. The children receive some sort of supplemental, education, but also that parent or caregiver gets an extra hour or two to work, right, and earn income. And then the governance aspect is all over the industry, right? We need to be compliant. There's a ton of auditing around it that Gary, I'm sure, is happy to step out of a little bit. But we all have to be very sensitive and focused on governance and affordable housing, so that no one loses their homes. Housing stability is important. And I think that's proven out even in this pandemic, as we see people prioritizing rent because of housing stability concerns.
Mm-hmm. Gary, what about you? Sorry.
There's a question here about taxes for New York City. And let me see if anybody wants to jump in and answer this. But recent reduction in assessed values for 2021 and 2022, which really means lower property taxes, are a factor, and clearly increasing NOI, which is a good thing. Something that we've seen only recently. Very surprising, but in a good way for landlords. Anybody wants to take that question, and how it affects, in your opinion, how it affects values and NOIs? Or
Sure. I mean, that's an easy one. Certainly, if taxes are going to go down, but I mean, it would be hard for me to believe that would be sustainable. And New York City certainly still has a budget crisis that it's going to have to work through, that we're all going to have to work through together. So, I think it is positive, but it's not something that I can see really changing values in a substantial way, because I don't, all of us believe that taxes, or property taxes in particular, are going to continue to rise in New York City.
Yep, and as you said, I think the most important piece of that is how much the city relies on property tax income for its operating budget. So it's coming down as a state of where we are today. I mean, but at some point it's going to have to increase.
Yeah. And it's also a zero-sum game. A lot of times when they do look to decrease property taxes, that means the assessments just go somewhere else instead. And in today's market, a lot of times they'll relook at the commercial real estate because it's doing so well and figure the values there are going up to offset the reductions to the affordable stuff and look at it as like a workforce housing switch. So now that the commercials are being assessed higher, the residentials can be assessed a little lower. But in today's day and age, that's going to be very challenging to do also.
And the truth of that is that the taxes or the assessments went down because rents have gone down. So it's either retail stores that are not paying, or some units that became vacant. The city usually relies on real property income and expense in this case of 2019 probably. So the NOI was lower to begin with, and that tax reduction only helps alleviate some of the pain. So it's, like Scott said, it's not going to be sustainable.
Shimon, Mayor, I wanted to just jump back into the
Sure.
ESG side. I thought Pamela brought up some really good points about, the needs of the residents in the affordable housing. I think, Pamela's right and really has been on the cutting edge of this for a long time now, because, ESG investing is something that has just become, globally a real headline for not just, private investors, but public investors. So, if you look at some of the statistics, I mean, ESG focused investing should increase and is projected to increase by like 50% over the next several years. And so you're just going to see more and more capital flocking to, the need for an ESG, just to make sure everyone knows what that means, but it's environmental, social, and governance. And so, that covers a lot. But things like solar tax credits, or solar projects, is something that Standard's focused on. We've done 4 solar projects across the country now and have another 8 in our pipeline, and it's something that we're going to continue to do. But also, at our in the governance level, we're really focused on on ways that we can be diverse, have be inclusive, and and really expand our thought, which is to say, have a diverse set of opinions from all, whether it's age, race, sex, or whatever it might be. I think that is a focus that we're seeing, not just from investors, from the government, from, really across the board. So I see that as a real positive sign for affordable housing, and that, we do have a crisis, but hopefully we can work towards, as you see the capital flow that direction, that could help.
As far as economics go, do you find that you're sacrificing a little bit on the economics to get to an ESG deal, or are you able to get the numbers to work that it's really not that much of a difference?
I would agree with Pamela that, it's really not, ESG is a good focus for the long term, and it will create additional returns. So I don't believe that it's a different return. I just think it's a better way to get to a good return.
And the other thing I would just say is you're highlighting a lot of things that are already happening. I mean, Pam touched on this in terms of the benefits of the community that are being provided to the residents. And in many cases, these things have been done in the affordable housing industry for a very long time. It's now that it's a point where it's something that we're highlighting, whether to our investors or to the folks that we're working with, that's saying, hey, look, these are all of the things that are being brought to the table here. And I'll just kind of touch on one thing that I did when I was in the public sector. When I was the head of the New York City Housing Development Corporation, we're a bond issuer. And one of the things we started highlighting, or we created, were these sustainable neighborhood bonds. And we talked about some of the environmental and social governance that are already being provided in these properties that we've been funding for decades. And the reason why I highlight that, it opened a pool of investors that were looking at purchasing the bonds that HCC was issuing that we hadn't tapped before. So it's just another perspective of doing the same exact thing that we've already been doing for a very long time.
And are you finding also, like in your current role, that you are seeing more investors or different types of investors flocking towards the projects that you're doing because of all the ESG and the new focus on ESG? Gary?
I would say yes. I mean, look, for Tishman Speyer, this is a new business line, right? So a lot of this is new. But yes, we're definitely seeing a lot of folks looking at this industry that weren't looking at it previously. In part, it's related to ESG, and I would also say in part is just related to COVID. You're seeing kind of declines that have been happening in other areas, whether it's office, retail, hotel, you take your pick as to everything that we were suffering over the last year. And because of the resilient nature of the affordable housing industry, there's very high demand, very little supply, which is part of the reason why we're in a crisis. And everybody understands the resilient nature of this. So you're seeing a lot more people taking a look at the sector.
Pamela, it's focusing on the resilient nature of it. I guess, just what do you find as far as people coming to you to invest? I know you're into the impact investing in ESG, but do you find people looking at it and saying this is an asset that has less downside than a lot of the other assets we're looking at?
I think there's certainly been more focus on the resiliency of it. I think the elongated pandemic has just, to Gary's point, really pointed out the differences in performance of the different asset types. And so when you look at affordable housing, which is, the majority, of Section 8 housing, for instance, is propped up by, federal funding. It's fairly affordable, and a lot of residents there, there's a mixture of essential workers and non-essential workers. So there are people with real needs in affordable housing. I think the emphasis has been placed here. I think Gary made another point, and I thought about this the other day, like this was the first, this election cycle was the first time I've heard so many people say affordable housing and like actually have a plan around affordable housing. I think what is critical is as capital enters the market, we do have this significant imbalance that we're talking about of supply. And we're short, millions of units needed in affordable housing. And so, as we think about, and Gary was intimately involved in this, is the low-income housing tax credit has really been the only way of creating new affordable housing in the market. And whether you like it or not, it's actually worked. It just hasn't created enough. And so, as the new capital enters the market and that program is starting, it's hitting its 30-year marks where, we're losing all of those rent restrictions. And there are real risks of those units exiting or being converted to market rate. We have to think about how that capital will, react when those affordable restrictions wear off. And if there will be some sort of impact view of how to preserve those going forward.
Do you find,
that's
sorry.
True. I think that's totally true. I think if we look at, where debt yields have been for, deed-restricted affordable housing and which is to say borrowing rates, that has continued to decline substantially during the pandemic. Now that's been true for market rate housing as well. But, what we've seen is that when when we've floated bonds into the public markets or when we've gone to, borrow money, if it has that ESG social impact investing stamp on it, we've seen increased demand for that, that product. And obviously demand for that product would lower yields or I should say lower costs for affordable housing. So there is that factor where, I can see for the long term, and I think Pamela's bringing up a good point around, around as potentially deed restrictions are expiring, what is going to happen. And I think for the most part, what we've seen is we haven't seen the opt-outs because the financing rates have been so attractive for affordable housing. And that, that is something I see continuing, and hopefully that is able to fuel our, preservation of the housing. And obviously because we have a crisis, not just because we're preserving or trying to preserve, we have a crisis because we're not preserving enough, I should say, but also because we really need to build, and we need to build a lot. So, if you want to get into that question, that's a question around, so much of it is there's NIMBYism, there's construction cost increases, there's obviously extreme red tape bureaucracy that comes into particular markets where you've seen the most homelessness, the most housing crisis, these places like Los Angeles, San Francisco, New York City. Those are the markets, not surprisingly, are the hardest to build in. And it's not just because of land prices, and land prices are a result of because it's hard to build. And so if there's ways to get that bureaucracy to be less complicated for affordable housing, then, and maybe it's different for affordable housing than it is for not affordable housing. And I think that if you were to do that, that could really help a lot. I mean, that's a complicated and long road, but it doesn't mean that we shouldn't try for it.
I agree. Gary, is there any thoughts on what people can do to is there any effort being made to cut back on the red tape for affordable housing to expedite some of these projects?
I would hope so. I'm a couple years removed from the public sector, but it was always a focus of ours to see when I was in the public sector to see how we could mitigate some of those challenges. The easier it is to get your affordable housing project completed or through the red tape, quicker you can get units out on the market to help house some of the people who are actually in need. And I would say, if you see that, in addition to all the other resources that we're talking about, be it a property tax abatement or other levers that the public sector can pull, I think everybody's looking at all of those things that can be done to help improve the speed in which we can execute on some of these transactions.
Mm-hmm.
We take a question.
Sure.
There's a question here about how does recent and newly proposed housing legislation in New York City council bills compare to other markets in the country, and how has any similar legislation that was passed in areas like San Francisco, Washington, D.C. affected the overall markets there? So I don't know who wants to take that.
I'm happy to speak to that.
Sure.
I would say that New York City has been the hardest for landlords, relative to San Francisco, Washington, D.C., Los Angeles, where there are rent restrictions in place. The rent control that does exist in those markets is not nearly as stringent as New York City's, and so that has, there is certainly further proposed legislation that I'm just not a fan of. In general, I'm not a fan of rent regulation or rent stabilization or rent control. I am a fan of deed restricted, regulated, affordable housing, but I don't believe in rent control or rent stabilization. I don't believe that helps with costs. I don't believe, I should say, cost of housing for residents, and I don't believe that helps with supply. In San Francisco in some ways has gotten hit just as badly as New York City during the pandemic, but the legislation hasn't been nearly what New York City's was.
I want to build on that. Just one thing that you said, Scott, with regards to regulation, rent stabilization, I don't believe in that either. I think that the Aegis TPA is a great example of we didn't really help the tenants. I mean, we didn't really do anything to help the tenants. We just hurt landlords by not allowing them to renovate units and bring them up to market, but we didn't help the actual tenant preserve their units over time or their rent over time, and that's an issue.
Yeah, I mean, I totally agree. There was just not enough collaboration between the state government and the people who are providing the housing, and that's not to say that a lot of real estate owners in New York City haven't taken advantage of the laws, and maybe there's been some bad actors, but I think that the state overreacted to the way that those really small minority of bad actors were acting, and I think for the most part you saw reinvestment into the buildings that needed it, and with this HPSP, it's just been the opposite.
One of the city council legislations talks about offering any building that goes for sale to nonprofits first, which is going to delay the process of a sale with a notice to HPD with about 6 months. I don't know if you heard about that, but you've heard about that. Okay, and have you seen it? I know it happens to be also in San Francisco. So I don't know if you've seen what are the different things that are happening there. No.
Yeah, I'm not not as much in the city of San Francisco. We own and operate, you know, a large amount of property in the Bay Area, but nothing in the city of San Francisco. And the city of San Francisco is the most, you know, sort of progressive about it. So, you know, in the markets that we're in the Bay Area, that legislation isn't, you know, isn't there.
We have 5 more minutes left. I just wanted to give everyone an opportunity to add any closing thoughts. Gary, I know you guys are looking to grow and you guys are looking to acquire more stuff. What are your closing thoughts and what would you like to see in the next year in the affordable market?
Besides me growing my platform, I would love to see just not only New York City, but our overall economy really start to come out of this. I would hope as the vaccine starts to kind of make its way throughout not only the country, but the rest of the world, that you actually start seeing people come back to cities, getting back into offices. I know it's not going to be exactly the same as it was before, but I would love to see us just as an overall economy kind of get back to work and start getting back to kind of living our lives so that we can kind of continue to improve on everything.
Scott, what about you? What would you like to see in the next year?
I agree. I mean, I'm looking forward to the time when, you know, when we can operate as the city that we know and love. But, you know, I think we have a big year coming in New York City with the mayoral election. You know, I think that the need for affordable housing is going to continue. I don't see any of the candidates differing on that need. But look, we need stability and we need clarity from the government in order to keep free markets operating, you know, efficiently, because instability or indecision that comes from, you know, from our local government or our state government or any the federal government just, you know, grinds markets to a halt. So, you know, I think that if there's clarity around what we're gonna, you know, what affordable housing developers and owners are able to do and how we can operate, then we'll work within that framework. But I think if we have, you know, differences of opinion, or it comes down from, you know, and we hear that the government saying, you know, we're not sure, or there's not clarity, then it creates problems.
Emma, what about you? What would you like to see
Yeah.
change?
Ditto on both comments. And, you know, I think I hope affordable housing remains a hot topic. I hope that this, you know, administration continues to focus on things like wage stagnation. I think that would help. I think that capital, I'm hoping that capital continues to focus on ESG and racial equity and affordable housing as well. You know, sometimes those movements tend to, you know, be in the moment. And so I hope that the corporations that are throwing around all this money to try to impact housing, I really, really hope that they are diligent with how they drive capital to communities and to people across the country.
Shimon,
Yeah.
I know you don't want to have to sell to charities, but other than that.
No, I'll tell you very simply, I want Gary Rodney, Scott Alter, and Pamela West to invest $1 billion each in New York City this year.
Amen.
As simple
to
as that.
Working on it.
Yeah, and one of the things that was actually interesting coming full circle, I did a presentation with Commercial Observer on a Zoom, and we were talking in the beginning of the pandemic, and everyone basically said that until you can go to a restaurant and you can go to a Broadway show, New York's going to have issues. And I think we did see that little window of optimism when they did open up the restaurants for indoor dining in New York, where we did see people want to start coming to the city. I'm extremely hopeful that we can get those people back to work. I know there's been a little bit of talk about maybe possibly opening up 25%. To me, that's a very encouraging sign, especially with indoor dining being required because of the cold weather. So I'm cautiously optimistic that between the vaccine and that everyone will eventually start coming back to the city. Hopefully when the weather gets warmer, we'll see tourism come back, and then hopefully people can start to have the money to pay the rent. Thank you all to the panelists.
Thank you.
For all your hard work. I also do encourage everyone. Shimon and I were instrumentally involved in helping James come up with this real estate program. We both presented to them. It's great to see a bunch of enthusiastic high school kids telling us that they want to become a designer, they want to become an architect because of the 3 or 4 sessions we've had with them, highlighting and encouraging them and going over plans for buildings and everything with them. I encourage each of you to reach out to James to see what you guys can do to get involved, whether it's take one of these kids for 2 weeks in the summer when they don't have school to further acclimate them and help them grow. We're training them for you guys. So I appreciate all the help we can get. I think it's a great program. Thank you.
Thank you, everybody.
Thank you. Thank you.